Hi everybody, it's Clinton. Thanks for joining in. We're starting about 2 minutes late. And I really appreciate everyone coming on. I know it's a bit rainy outside in Halifax, but if you're tuning in from other areas all over the country, maybe you're going to have some different weather, I'm not sure. Anyway, we're going to respect your time and we're going to keep this to 30 minutes. And we will roll through the beginning. So, if you have any questions, you can certainly ask questions on your GoToWebinar technology. There should be a little pop-up on your screen, and I can review the questions as they come in. And we'll answer any questions that you may have throughout, hopefully, the entire presentation. So right now, we'll roll through, we'll go through the agenda, and I'll give you a little bit of background about me. So here's a little bit about me. I've been a mortgage broker in Halifax for over a decade, and we've reviewed over 10,000 mortgage applications. So I can tell you, we've seen everything. We've seen everything from people with good credit, bad credit, indifferent, all kinds of different stuff. So, really, there's nothing out there that surprises us, I don't think, anymore. And I can tell you one of the big things around a mortgage application is credit. I was on Global News Morning on Monday. We talked a little bit about credit, and we'll get into a little bit more on that as we go through. My goal really with this webinar is all about education, so I want to share as much information as I can. And the reason that we really started this business was to offer customer-oriented mortgage lending. You walk into the branch and there's such a huge turnover in terms of staff that it's really hard to have a relationship. And I think that's one of the big reasons that we win here. It's because of really being consistent, and we're doing the same things over and over again. I understand your credit report, and the ability to properly navigate the report is essential. You need to understand this as well. So this is a little bit of a quote. Understanding your credit report and being able to properly navigate the report is essential. This becomes a large part of being able to borrow money from a lender. It's one of our blog posts. And here are the topics for our webinar. What exactly is your credit score? What is a good credit score? What credit score do I need for a mortgage? How can I keep track of the changes to my credit? What are the best ways to improve my score? What are the different types of credit? Which one is best? And how can a mortgage broker help me with my score? And is there anything else that I need to know about credit? I'm sure there's going to be other things that pop up through the webinar. I'll take it as it comes, and I may come up with a few little antidotes here and there, and we'll go through as much as we can. So, what exactly is a credit score? It really is the tool that measures your ability to manage your own credit. Your score keeps track of the different types of behavior you have with your credit. So how is your utilization? How is your payment history? What are the different types of credit you have on your report? And it helps lenders determine how worthy you are to really borrow funds going forward. And what is a good score? I get asked this all the time. The score is out of 900, and scores above 680 are considered good. Typically, the minimum that we require for our standard mortgage transaction is 600. But anytime that you have a score that's below 680, there's been some challenges. And I'm not saying that we don't do mortgages for people that have credit that are below that range, but I can tell you that it's going to become more costly. The rate's going to be higher, and maybe if you're buying a new home, you're going to have to borrow, or you're going to have a larger down payment. Typically, people that have had damaged credit in the past, if the score is below the 600 mark, and if they want to buy a home, they need to put down 20, 25, 30, 35, or maybe even 50% down. Every Canadian can get a mortgage, no matter what their past credit history is. But obviously, the more challenging the credit, the more expensive the mortgage might be, or the more skin that you might need to have in the game. A score of 720 plus is really ideal. And that really means that you're going to be able to access the best rates, as well as typically people with those type of scores, as long as the income and the assets are in line, they're typically being approved. What score do you need for a mortgage? The most straightforward answer really is it depends. There is no box, no magic out there. Every case is really handed on, it's reviewed on a case-by-case basis. We've done mortgages for people that have a 900 credit score, and we've done people with a credit score that doesn't exist. So it really just depends on what type of risk tolerance the lender has. If you have a 500 credit score, chances are you're not getting a mortgage from Scotiabank. We all know that. But there are lenders out there, whether it's alternative lenders, private lenders, that may look at the situation. But again, the harder the credit, the higher the rate. And it's really about maintaining good credit and what you need to do that. And, we've all had challenges in the past. We forget to pay our cell phone bill, or, you've had health issues, or matrimonial breakdown, or loss of business. There's lots of reasons why people have had blips in the radar. And if the radar is explainable, chances are you can still be able to be qualified for a prime mortgage. If you missed one mortgage payment, that could be a challenge. Mortgage payments are typically the one piece of credit that lenders expect that you're going to make regardless of your situation. People don't want to be out on the streets. If you missed a credit card payment 3 years ago, probably not going to hurt you. But everybody's situation is different, and credit really is a snapshot in time. It's a little bit like a snowflake. And I think that's what makes it so interesting, and that's what makes our job interesting, because everybody's situation is different, and we really look at each credit report individually. Obviously, 720 and above is most ideal. How can you keep track of your credit? I think there's so many interesting ways now, and there's a lot of free services out there, and we have a couple here on our screen. And this is going to be available online on YouTube and on our website down the road, so you don't necessarily need to worry about writing this down. Or if you have any questions, you can certainly email me directly, and I can fire it back to you. But for Equifax, there's Mogo, and there's Borrowell, and for TransUnion, there's Credit Karma and CreditView. CreditView is only available for Scotiabank and RBC customers, but Credit Karma and Borrowell are both free, and they're apps that you can download on the App Store. So if you have an iPhone, it's available. And I think likely if you have an Android, they offer the same apps on there. It's really cool. I have them myself. I love it. You can keep an eye on credit inquiries, utilization, payment history, lots of cool stuff. And it will send you notifications when things change. Now, you can also review your credit directly with Equifax and TransUnion. And we may not have said that, but there are two credit reporting agencies in Canada. So you can certainly track your credit directly with them as well. And typically, the TransUnion and the Equifax reports, you can send them a piece of mail and they'll send you back a free report, but it won't necessarily have a score. If you want to do the credit monitoring, or if you want to get a report with a score on it, typically there's a charge. So I know with Equifax, it's $19.99 a month if you want to use their service. But you can use Borrowell for free. And people are like, well, why can I use Borrowell and it's free? It's because Borrowell is going to try to sell you some information or sell you ads to potentially, credit cards, loans, etc., directly on their app. So if you're willing to get a few ads, then you can get free information. Now, I typically find that the information available on TransUnion and Equifax is a little bit more detailed. As well, if you do sign up for those credit monitoring services, some of them have some insurance around identity theft, and also if there's any problem on their report specifically, you can file a dispute online, or you can download the forms to file a dispute. So I think there's certainly a value of going directly to TransUnion and Equifax, but if you just want to keep kind of a casual eye on things, Credit Karma and Borrowell definitely would recommend it. So we're getting to the point of the webinar that we really want to talk about how can you improve your credit. 90% of Canadians have great credit. They've never had any problems, or they've had a few little problems here and there, but overall their score is very strong. That doesn't mean that everyone is in that same boat. Like I said before, health issues come up, divorce, loss of business, and you may have had some blips in the radar, or maybe you were just careless. That's reality. We're all human. But there's lots of ways you can improve your score on it. This is what I think is so cool. Credit is a snapshot in time. As I said, the score is out of 900. Typically, the quickest and the easiest way for you to impact your credit score is really around utilization. The majority of the people that I see that have a low score have high balances on their credit, revolving credit, or their balances are higher than their limits, what we consider an over limit. Typically, the way that it works is you want to stay below 30% of your approved limit. So if you have a limit of $10,000, for example, you don't want to go above $3,000 of utilization. Utilization really means the balance that is reported on your statement. The balance throughout the month could become higher because at the end of the day, that is your limit. But the balance that shows on your statement is what's going to be reported into the credit bureau. Oftentimes people are like, well, I paid off that debt, or I paid down that debt. That doesn't matter if you paid it down yesterday. Whatever is showing on the statement is what shows on the credit bureau. So think about that. Know your statement cutoff dates. And if you really are using your credit card aggressively, potentially you want to do a lump sum payment before the statement generates. So then the balance that's reported to the credit bureau is lower. So on the flip side, I have lots of people who use their credit card and every month it reports with a balance of 0. That's terrible. Why are you using the bank's money and paying it off? You should be using their money for free. Typically what I recommend is use your credit card, use it and pay it, use it and pay it. Let it generate with a balance that's not above 30%, and then pay it off in full. The reason that that's beneficial is it shows that the card is active. If it's always reporting a 0, it basically will nullify your score. And if that's the only thing that you have, if you don't owe anything else to anyone else, you won't have a score at all. So if you're always letting your statement report with a balance of 0, that can be negative. And we all know that if you pay off your balance in full, you won't pay any interest. So you might as well use the bank's money for free. The other thing that's really important is paying your bills on time. Notoriously, I see people with student loans that have had missed payments and cell phone bills that have had missed payments. They both report to the credit bureau. Get your cell phones to automatically be charged onto your credit card. That means you'll never ever miss payment ever again. And any derogatory stuff that's been on the credit bureau will fall off after 6 years. So it really will come off. It's not on there forever. And it's not that you have bad credit for life. You're not in purgatory. Things do get better. Everything in Nova Scotia falls off 6 years after the date of the last activity. So for example, I saw a client today that had a written off American Express. And they're like, well, should I pay it? Should I not pay it? They had a collection item and they had the account that was both showing past due and written off. Written off still means they can collect it. And in the province of Nova Scotia, they have 6 years to collect it from the days of the last activity on the account. But it was going to fall off in February. So I said, you know what? Why not wait the 6 months or 5 months, and then it will be automatically erased from your credit bureau. And that's why I think it's so important to keep an eye on your credit, know what's going on, and if there are issues, figure out what the solution is. Do you pay it and get it reported that it's been corrected? Do you wait it out? Everybody's situation is different, and I mean the time frame is really so important. You know, I see sometimes people have had a slew of problems, a slew of written off accounts. Well, maybe at that point it does make sense to wait it out. But you really need to have good reestablished credit. And if you've had a problem in the past, don't make the same mistake twice. Make sure you keep your nose clean and continue making your payments on time. We like to refer to something as the 2-2-2 rule. We like people to have good, clean credit for at least 2 years, have 2 established pieces of credit with a minimum balance or minimum limit of at least $2,000. So that means that you may want to have a car loan and a credit card. Make your payments on the car loan and use the credit card appropriately. Don't go above 30% of the limit, and make sure you make all your payments. Then you'll have great credit. Great way to maintain it. And let's talk about some of the different types of credit. Not all credit's equal. You might be surprised to learn that credit is not all the same. Some revolving accounts, like credit cards, have a different impact than installment loans. There's student loans, and the credit mix is so important. If we see a consumer that has all kinds of credit accounts from Fairstone, Easy Financial, that is not as favorable, even if they're paid on time, as you having credit accounts from Scotiabank or TD Bank or the credit union. The different types of lenders really do impact your score overall. And good lenders obviously are more favorable than alternative lenders. And I'm not saying that having a Fairstone loan or a Desjardins loan is going to mess up your credit. It's not. But if you've had issues in the past, obviously dealing with better lenders going forward is going to be more advantageous to you than always dealing with alternative lenders. Because by the time you want to get a mortgage, we're going to really look at the different types of credit accounts that you have. And as a mortgage broker, how can I help you with your score? Well, you might be surprised what we can do to help you. You might be surprised to learn that we can help. And specifically with Equifax, we have a commercial account. So what that means is if there have been issues on Equifax in the past, we are able to do an investigation. And there is a cost to the investigation. It costs around $17. But we're able to correct sometimes issues that are on the credit bureau. Typically, we charge the client back the cost to fix the credit bureau. But we're able to get it fixed between 2 and 30 days. And sometimes consumers just can't get it fixed. They try with consumer relations, they try online, and for whatever reason, they can't get it fixed. But with us, we're able to fix it. I sometimes see clients that have multiple credit bureaus because maybe they applied for credit one time and didn't give the SIN number, and it creates 2 bureaus. I'm able to help get them to get it combined and to really have their best chance at approval and the best rate. And really having great credit is going to make your whole life easier. And I'm not just talking mortgage lending. I'm talking about sometimes employment, super important. And there's all kinds of things that are tied into credit that you might not even think about, like insurance. And that can really impact your insurance rates. What else do you need to know? Well, we went over quite a few things here in the last 25 minutes or so, and the importance of credit as well as giving you a few options to keep things on track. Everyone's situation is different, so speaking with an unbiased mortgage professional like ourselves before you start the search can really help you achieve your goals of home ownership, or maybe achieve it faster. I really strongly recommend the Borrowell and the Credit Karma. Know where you're at, and then we can know what issues there are that need to be fixed. So you guys have submitted some questions. This is the fun part. And I'm going to answer these questions, and if you think of any other questions, you can certainly ask them. There is a box on your screen that you can ask me questions if you want, and I will roll through those after we answer these questions that were submitted from you. I do see some things that have been asked. We'll go through those ones for sure. So the first question, is it better to pay back debt or save money first? I think it's a great question. In Canada, you need a minimum of 5% down to buy a home plus your closing costs. Typically, we tell people the rule of thumb is that you want to have 8% of your purchase. So if your purchase price is $200,000, you want to have about $16,000 for down payment and closing costs. If the numbers work for you to carry your debt, then you can carry the debt through your home purchase. But for some people, and I would say the majority, it makes sense to pay back the debt, specifically consumer debt. I wouldn't worry as much about car loans and student loans. I would make all your regular payments, but as long as those fit within those ratios, I would just make sure that any credit card debt was paid down and lines of credit. It doesn't need to be paid off, but again, paying it down below 30% of the limit, I think that's the first place to start. I'm going to load all the questions here because we're not in order. How does a consumer proposal affect getting a mortgage? If you're in the middle of a proposal, if the proposal has not been paid, it needs to be paid off first. And if it's just been paid off and you want to get a mortgage, we're going to have to go to an alternative lender. So that means you're going to need a minimum of 20% down, if not 25, 30, 35, 50%. Consumer proposal and bankruptcy is very similar. The difference with a consumer proposal is sometimes you can get a mortgage much sooner than a bankruptcy. And typically, prime lenders will look at you sooner than with a bankruptcy. So with a consumer proposal, you still should have the 2-2-2 rule, 2 years of good reestablished credit, 2 new pieces of credit with a minimum limit of $2,000. Generally, what is the best thing a prospective home buyer could do to improve their credit? I think paying down the balances is great. Having a high limit, that can work. Some lenders will penalize you if you do have a lot of available credit. So keeping that tight, having one credit card, one line of credit, a car loan, that's not going to hurt you. As long as you're making your payments on time and the ratios work, I think that's appropriate. And having high limits and low balances is the way to go. If I have a credit card with a small limit and a large limit, should I only use the one with the large limit? I'm going to go out on a limb and say yes. Why bother keeping the one with a small limit? I'm not sure. I would just keep one. Why not cancel the small one? But I would definitely use the one with the large limit, and I would try to keep the balance below 30% of the limit. So we're going to answer some other questions, and if you think of anything else, certainly put it in the question box. The first question that we had got asked here, let's just open this up. How accurate are credit simulators online through online banking? Great question. I would say they're not 100%, but I think that it definitely is accurate in the sense that it will improve your credit. Do they know it's going to increase your score by 20 points, 50 points? No. It's an estimate, but it will definitely impact your score. So I think that if there's recommendations, they're probably right. When you check my credit score for a mortgage, does it negatively impact your score? The answer is credit inquiries do impact your score. There's really, and we didn't cover this, but it's really utilization, payment history, inquiries that make up about 90% of your score. There's also public records, collections, bankruptcies, consumer proposals, and how many times you move impacts your score. When we check your score, it's coded mortgage. So it's typically good for 30 days. And even if you're down the street at Royal Bank and then you come to me and I check your score, it dedupes to one inquiry. And the whole score piece is only about 10% of your score. So overall, not a lot of impact. And you need a credit check to get a mortgage. And we do a credit check for everyone who comes in with their consent, of course, even to do a pre-approval. Why does Equifax hold on to records of every credit account you've ever had, regardless if it's long paid in full? Great question. This is actually not accurate. It's actually TransUnion that holds on to everything. So TransUnion, and we often will have lenders check TransUnion and Equifax. Equifax, closed accounts, bad accounts, all fall off after 6 years in the province of Nova Scotia. TransUnion, things stay on forever if it's good, which, I mean, is positive. So if you had some credit issues in the past, the bad accounts will still fall off TransUnion, but all the good accounts will stay. So we'll show your current accounts and any of your old accounts that have been paid off. So oftentimes people's score will be higher on TransUnion than it is on Equifax because there's more history. So with Equifax, things will still fall off after 6 years if it's bad. If it's paid, with TransUnion, it will stay on if it was a good inquiry. So, any other questions? Let me just look in our little question box here. I think we have answered them all. So, that wraps up our webinar. If you have any questions, certainly feel free to reach out. I'll let you guys take a picture of the screen. I'll keep this up for a second. So you can certainly get in touch. We would love to hear from you. You can feel free to send us an email, give us a call, send us a letter on a carrier pigeon, however you want to get in touch. And certainly check us out online at teamclinton.ca. I appreciate everyone tuning in, and thanks for watching. Have a great day. Thanks, everyone.